Hey everyone, and welcome back to another explainer. Today, we are unpacking a highly systematic, incredibly visual approach to the markets. If you're someone who loves structure, clarity, and just strictly rules-based logic, you are absolutely in the right place. We're mastering the 9 EMA plus 21 EMA trading strategy, and we've translated the source material right onto these slides so you can see exactly how this engine works, piece by piece.
But before we get into the actual mechanics, let me ask you something. How do you currently navigate strong market trends without second-guessing every single move? I mean, we've all been there, right? You're staring at the flickering charts, the market is moving incredibly fast, and suddenly emotion just grabs the steering wheel. You buy a little too late, maybe you sell way too early, and chaos completely takes over. What you really need, and what the source material strongly insists upon, is a strict, highly structured playbook to just cut right through that noise. You need clear visual rules that tell you exactly when to jump in, and honestly, more importantly, exactly when to just sit on your hands.
All right, so here's the game plan. We're going to completely demystify this system across 5 quick sections. We'll kick things off with the 3-minute strategy, then move into executing the buy setup, followed by executing the sell setup. After that, we'll cover ideal market conditions and wrap it all up with some absolute risk management essentials.
Starting right off with Section 1, the 3-minute strategy. This is really the foundational engine of the entire EMA playbook.
Okay, so our foundational tools here are super specific. We are using the 9 exponential moving average right alongside the 21 EMA, but the absolute crucial key here is the time frame. This entire strategy is strictly plotted on a 3-minute chart. Now, you might be wondering, why 3 minutes? Well, it perfectly filters out all that erratic, choppy noise you get on a 1-minute chart, but it gets you into the actual trend way faster than a 5-minute chart would. The 9 EMA is tracking that rapid momentum, while the 21 acts as our slightly longer-term trend filter. Together, they form this dynamic boundary that basically dictates every single subsequent move we make. Moving right along to Section 2, executing the buy setup. Let's look at how we go long when that momentum actually shifts.
Get ready, because this is where the magic happens. Think of this like a perfectly executed play in sports. Step 1, you are watching the chart, waiting for the faster 9 EMA to officially cross above the slower 21 EMA. That's your signal. But hold your fire. Step 2 is the actual trigger. You absolutely must wait for a bullish candle to fully close above both EMAs. I literally cannot overstate this. Wait for the close. Step 3, the very moment you enter, you drop your stop loss right below the recent swing low. That's your shield. And Step 4, set your target. You're aiming for a 1-to-2 risk-to-reward ratio, or simply the very next resistance level. 4 steps executed in perfect chronological order.
Which naturally brings us to Section 3, executing the sell setup. How we go short when the market drops.
Look, if you understood the buy setup, you've pretty much got this. The sell setup is just the exact inverse. It's a total mirror image. Step 1, you're now waiting for that 9 EMA to cross below the 21 EMA, which shows us downward momentum. Step 2, again, patience is everything here. Wait for a bearish candle to firmly close below both EMAs. Step 3, once you execute that short sell, place your stop loss safely above the recent swing high. And Step 4, your target remains completely mathematically disciplined. Aim for that 1-to-2 risk-to-reward ratio or the next logical support level. It's the exact same logic, just flip totally upside down to capitalize on a dropping market.
Now, looking at these two side by side is a game changer for internalizing the visual pattern. Just notice the symmetry here. On the left, your buy trigger requires an upward cross and a bullish close. On the right, the sell trigger demands a downward cross and a bearish close. By viewing them like this, you're literally training your brain to recognize these conditions instantly on the fly. There's zero guessing involved. The lines either cross and close exactly as required, or they don't. Simple as that.
So let's talk about the math for a second, because this non-negotiable 1-to-2 risk-to-reward ratio is absolutely critical. What does this actually mean in plain English? It means that for every $100 you risk, you are actively targeting $200 in profit. And here's why this is the mathematical anchor of the entire strategy. With a 1-to-2 ratio, you can actually lose more than half of your trades and still be profitable overall. It's a built-in safety net that ensures when you do catch that momentum, your winners vastly outpace your losers.
Next up is Section 4, ideal market conditions, because you really have to know your battleground.
Because here's the truth. You could have the absolute best rules in the world, but if you play them in the wrong environment, you're going to lose. On the left side, we can see exactly where this strategy thrives: strong market trends, highly liquid stocks, or indices like Nifty and Bank Nifty. It needs volume. It needs clear direction. But check out the right side. You have got to avoid sideways or choppy markets. If those EMAs are just tangling together and the candles are endlessly bouncing back and forth, step away. Choppy markets will literally eat trading accounts for breakfast. This strategy demands a trend. No trend, no trade.
And finally, Section 5, Risk Management Essentials. This is all about surviving to trade another day.
We definitely need to confront a sober reality check straight from the source material here. Read this with me. No strategy guarantees profit. Always use proper risk management and practice before trading with real money. Now that isn't just some legal fine print, it's the absolute golden rule of our explainer today. We've mapped out the EMAs, we've covered the exact triggers, but listen, none of that matters if you risk way too much capital on a single trade. Guarantees simply do not exist in the financial markets for sure.
Which brings us to our final thought. The entire playbook is right here. You know about the 3-minute time frame. You know how to use the 9 and 21 EMAs. You know exactly what a valid buy and sell setup looks like, and the specific market conditions you need. You know the strategy, but do you actually have the discipline to follow the rules? Can you force yourself to sit on your hands during a choppy market? Can you truly wait for that 3-minute candle to actually close before jumping in? The system is incredibly structured, but at the end of the day, your success comes down to your own discipline. Think about that as you process everything we've covered, and I'll catch you on the next explainer.